Welcome to Yahoo Finance Live. I'm Julie Hyman. That's Josh Lipton. We're here at the New York Stock Exchange with your big three at 3, the 3 stories you need to be watching at 3 p.m. Eastern. Wild moves for the markets on the heels of new comments from Fed Chair Jerome Powell. Stocks initially sliding on his comments as he suggested rates may need to go higher, but also said the central bank needs to take a wait-and-see approach.
My colleagues and I remain resolute in our commitment to returning inflation to 2% over time. Given the uncertainties and risks, and given how far we've come, the committee is proceeding carefully.
After the speech, Fed funds futures pricing indicating near certainty that the Fed will hold rates steady at its next meeting.
And the higher rate environment putting the housing market in a deep freeze. Existing home sales falling to their lowest levels since the Great Recession as mortgage rates creep higher. What it means for the broader economy, that's coming up later this hour.
And more chaos on Capitol Hill. Congressman Jim Jordan backing a move to empower Speaker pro tempore Patrick McHenry. But even that effort is facing opposition within the Republican Party. We're following the latest developments as the future of the House hangs in the balance. Let's get you up to speed on the market action here with 1 hour to go in the trading session. We are seeing a downdraft for markets here. We definitely have been seeing some volatility following those comments from Jay Powell, which we'll get into more in a moment. Right now, the Nasdaq leading declines off by 0.9%, followed by the S&P off by about 0.75%. The Dow off almost 0.6%. Within the S&P, it's consumer discretionary that is leading declines down sharply. Real estate, financials, and healthcare are also experiencing declines. Last I checked, the only group that was up was communications services.
Now let's get into some of the Fed speak today. Fed Chair Jay Powell, Julie. So this was interesting because on the one hand, he says inflation, it's still too high. We don't like what we're seeing. We're probably going to need a slower growing economy to get it back to where we want, 2% target. Says that additional evidence of persistently above trend growth or that tightness in the labor market is no longer easing. That, he said, could put further progress on inflation at risk and could warrant further tightening of monetary policy. But then he says, right, it wasn't all hawkish. Then he also says there's evidence the Fed's rate hikes are impacting the economy and said there may still be meaningful tightening in the pipeline. So kind of something for the hawks, for the doves. I think bottom line, maybe we're back where we thought we were, which was maybe we're on hold.
Yeah, and, kind of echoing a lot of the commentary that we've been hearing from other Fed officials as of late, one of the other things he talked about was the impact of the Treasury market on the Federal Reserve's calculus. Listen to what he had to say on that front.
Financial conditions have tightened significantly in recent months, and longer-term bond deals have been an important driving factor in this tightening. We remain attentive to these developments because persistent changes in financial conditions can have implications for the path of monetary policy.
So indeed, as we've been talking about, the Fed is cognizant of what's happening in the bond market. And if you look indeed at treasuries today and the direction of treasuries there too, we've been seeing some volatility. But right now, yields are pushing up, which is kind of interesting given, this maybe a little bit of everything in the speech for the Bulls and the Bears. But look at that. We're near 5% on the 10-year, way above it now on the 30-year.
30 ticking away above 5%.
And that is definitely causing some consternation for some investors.
Yeah, and I think also some of the people you've been talking to have also been saying when you watch these yields moving this quickly, it's not just where they are, it's the speed of the move that gets people a little bit nervous, right? It just feels unanchored, and it gets some people, listen, we've heard on this program, economists and strategists, they start to get worried about what that could mean. Things they can't necessarily foresee, but what kind of dominoes is that tripping up down the line?
Right, and it speaks to, confidence or lack thereof in the Fed at this point, and sort of confidence or lack thereof in the market at this point. So, even though we're in the thick of earnings season, there is a lot of focus on that. There's also this sort of backdrop of what's going on here with people watching the Fed. So let's get another perspective on all of this. Stocks are, as we said, trading lower as investors price in recent earnings results and commentary from Fed Chair Powell. He acknowledged in a speech today the resiliency of the U.S. economy and says the committee will proceed carefully with its decisions on monetary policy. He also said of the Fed's inflation fight that maybe we just need to get more time.
It may just be that rates haven't been high enough for long enough. And again, it's all happening in a context of very strong demand.
And Powell's comments come, as we've been talking about, as the 10-year yield nears 5%. For more on the Fed and the recent moves in the bond market, we turn to Kevin Nicholson, Riverfront Investment Group Global Fixed Income CIO. Woo, it's quite a day for you, Kevin, listening to these comments, watching the action in the bond market. First of all, what is your reaction to Powell's speech? Is it hawkish? Is it dovish? What, was there not a clear message in there at all?
Julie, there wasn't a clear message because he hedged his bets at every turn. However, my reaction to his speech was I really didn't have a reaction because seeing how strong the economy has been, I had expected for the Fed to raise rates once again this year before actually pausing and keeping rates higher for longer. So I think that this was all in preparation in preparing the markets for what is to come.
And so, Kevin, I think a lot of investors are with you. They see higher for longer now. But when do you think, I'm just interested, Kevin, when do you think the Fed could actually start thinking about cutting? Is that a 2024 dynamic?
Josh, had you asked me this a couple weeks ago, I would have said probably at the end of third quarter of 2024. However, seeing the strength of the economic numbers that have been coming out, it really leads me to believe that the Fed is not going to cut rates at all in 2024. And it won't be until 2025 that we actually start seeing them cut rates.
Kevin, earlier today I had the chance to talk to Mohammed El-Arian, Chief Economic Advisor at Allianz, of course, President of Queens College as well. And he talked about the sort of unstable footing that we're on right now. I want to play for you what he said and get your reaction.
There's a fear, and I hope it's just a fear, that this could break something. And it's important because we have no anchors. Fed policy is no longer an anchor. Fed policy is too backward looking, is too data dependent. So there isn't clarity on where we're going to be when. And the economy is no longer an anchor. So this is a really hard time for the bond market. And we need stability. We desperately need stability.
So, Kevin, listening to that and that lack of anchor here for the markets, how, as a market participant, how do you even navigate that? And what are the implications for the economy?
I think you have to navigate it very carefully. I think one of the big things that was coming across in that comment was that, in the past, the Fed would have seen the reaction function react a lot quicker to a 500 basis point rate increase. This time around, that has not happened. And the reason for that, I believe, is because the biggest asset that anyone will hold is their mortgage on their home. And most people refinance or locked in at very low rates. So the rate increases haven't impacted the consumer nearly to the same degree they would have in 2007 when folks had a lot of adjustable rate mortgages. Very few individuals in society now have adjustable rate mortgages, so you're not getting the same impact. And so I think that is what is making investors a little uneasy because they don't know how far the Fed actually is going to have to go to actually get the result that they are searching for. And that result is to actually slow the economy down without breaking something. And, 500 basis points is a lot. And I think what the market is concerned about now is that, does that mean that we may have another 100 basis points to go? And if so, what will that do to the economy and the impact of what it's going to do to housing and what it is going to do with just borrowing in general going forward?
Kevin, within fixed income, I'm interested where you see opportunity right now. Is it treasuries, corporates, munis, junk? What are you telling clients, Kevin?
So for our clients, one of the things that we've been focused on is trying to leg ourselves back into getting duration into the portfolio. We think that it's at 5%, we think that the long end of the curve is going to anchor around 5%. It may overshoot a little bit, but we think that this is where we're probably going to settle in pretty close to these levels. So for us, it is just gradually adding duration into the portfolio. And there's a lot of money sitting in money markets. And so one of the things that we've been trying to do is, rather than put money in money markets, we want to focus on taking interest rate risk and less credit risk, because we focus our portfolios at this point on the fixed income side mostly with credit, and it has been at the front end of the curve. While you can get some interest rate risk into the portfolio, not having to extend all the way out to the long end at this juncture, in the 2 to 3 year part of the curve, and still get north of 5%. And I think that that's where we're starting to, tell clients that they need to at least start moving towards and start locking in some of these higher rates. And then we'll see if the long end actually anchors and follows our thesis, close to these current levels. And if so, then we will move further out on the curve and get more interest rate risk in the portfolios.
And Kevin, I know that you focus on fixed income, but of course you work in a shop that also does equity, and we're coming off a pretty rough stretch for the 60-40 portfolio. And I'm wondering what you're hearing from your clients and what you're telling your clients, not just on where to position in fixed income, but about asset allocation right now.
Well, one of the things that we've been telling our clients is that it is time for us to really rethink how we're thinking about our portfolios. I know the 60-40s had a rough time the last 2 years, largely because fixed income has been selling off and hasn't been that risk mitigator in the portfolios. But I do think that going forward, you're going to see more folks add more fixed income to their portfolios, and they're going to take less risk with equities. Because right now, what I'm seeing is that bad news is bad news, and good news is terrible news for equities. If we continue to see the strength in the economy, equities are going to be capped to the upside. On the upside. So we need to think about where are we going to get that return from. And, the equity risk premium has disappeared relative to fixed income. A year ago, that equity risk premium was about 180 basis points. Today, it's non-existent. So that is telling us that the asset allocation going forward needs to be leaning more income driven, and you can get that income a multiple ways. It doesn't necessarily have to be in a bond, but you could get it in a bond-like security. You can use covered calls to generate income in the portfolio, but it's going to be things like that are, your traditional equities are going to go down as far as an asset allocation in the portfolio going forward, I believe.
Kevin Nicholson, thank you so much for joining us today, Kevin. That was great.
Thanks, Josh.
Let's get to some movers. Shares of Taiwan Semi are in the green today. It's after the world's largest contract chip manufacturer beat on both the top and bottom lines for Q3, with the CEO saying it sees signs of recovery in consumer technology, but it revised its full-year capital expenditures plan to $32 billion, the bottom of its range, after the revenue slipped around 10% on the same time last year. So this, we got reports, earnings, and beats. Gross margin, by the way, 54.3%. That was a beat. Its most advanced chips seeing a strong ramp up. And of course, we pay attention to this one, Julie, world's largest contract chip maker. So in other words, the NVIDIAs and Apples of the world, they may design their chips, but it's Taiwan Semi that's actually making them. That's why we pay attention.
Yeah, exactly. And CC Wei, who's the CEO, interesting commentary here. He talked about the chip market hitting bottom very soon, but still expressed at least a little caution about the Chinese market in particular, because we know there's some uncertainty around the demand from China and economic growth in China. But he talked about early signs of demand stabilization in both the PC and the smartphone markets. And that's really what investors want to hear. It's what people in tech want to hear. We'll have to see if that materializes. But in the wake of this, the stock was added to Goldman's conviction buy list because of these hopes for a rebound.
Yeah, they say decreasing inventories healthy growth outlook. They take their price target to 115 there.
Yes, we shall see. On the flip side of that story, I think you could say, is another story within technology, and that is Nokia. Those shares off by 5%. Nokia announcing it's going to be cutting 14,000 jobs from the company in an overhaul in order to cut costs. That represents between 10 and 15% of the workforce. I saw about 16% of the workforce. There was one figure. The company says it's going to save around $420 million by the end of next year. And this is all coming as the company came out with earnings that were weaker than estimated. Adjusted operating profit, 424 million euros in the quarter. Analysts had been looking for 545 million euros. So substantial shortfall here. And a lot of it has to do with capital spending on the part of network providers and demand for 5G, and that's sort of slowing down.
Yeah, not easy if you're a maker of 5G equipment right now. As you said, operators are cutting CapEx. Ericsson, by the way, also recently posted an outlook that disappointed. So same market, same deal.
Yeah, exactly. And Nokia also saying the total addressable market is now going to fall 9% this year for the mobile networks market. It had previously said that drop would be 2%.
Wow.
So, yeah, pretty significant downgrade.
And let's check out Blackstone here, too. Shares under pressure as well as a reported 12% decline in quarterly profit available to shareholders. Company citing higher interest rates and a pullback in deal making as the catalyst for the slow return. So 12% drop in quarterly profit available to shareholders. That came in at 94 cents. Street was at 101, so pretty good miss there. Deal making under pressure, no surprises. Debt costs rise there. Private equity, questions about whether that picks up, Julie, just given all the turbulence we're seeing. Blackstone president quoted here saying there's uncertainty around rates and inflation. An environment of uncertainty, says, reducing transaction volume.
Yeah, I mean, we see what's going on out in the markets right now. We've been talking to a lot of people about it. Fee-related earnings down 5%. The amount of money deployed for new deals by Blackstone down 60% year over year. So, for an alternative asset manager, when you see this kind of macro environment, when you see less demand for debt, when you see less demand for deals, this is, one of the places where it's really going to be felt.
And here's what Evercore telling the clients about the name. You can't grow to the sky, Julie, when markets are down and rates are up and you're long a lot of real estate and PE. They do, though, still have an outperform on the name.
Trees don't grow to the sky. That's a well-worn old Wall Street kind of saying. Gotta love that. All right, we're just getting started here on Yahoo Finance Live. Coming up, housing hurdles. Mortgage rates are approaching 8%. When will homebuyers see a turnaround? It's the question we're all asking. We're going to try to tell you. And the future of tech, a new survey just out says every person will have 6 streaming subscriptions by 2027. What does this mean for your wallet? And the price of pills. Pfizer is charging how much for a 5-day course of Paxlovid? We'll tell you that much and more when Yahoo Finance comes back. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
The Treasury sell-off, leaving many investors feeling the pain. Jared Blickley's here on the floor of the New York Stock Exchange with a closer look at what that pain looks like. Jared?
Oh, Julie, it's so painful. We're in a 3-year Treasury drawdown. This has only happened twice before in the last 100 years. You'd have to go back to the 78 to 80 era, and you would see, okay, we had a 3-year drawdown, then 32 to 33, somewhere in the midst of the Great Depression, and now that's currently what we're facing. But I want to go to the Wi-Fi Interactive and just kind of chart what's happening today in the 10-year. You're going to note that in the daily and 52-week range, we have a high of 5.00%. So that's the first time we've reached that level since 2007. And if I pull up a chart here, this is a year-to-date. You can see here the 3.25 lows in March. That was in the midst of that internet banking panic, and then it's been off to the races, and we've even accelerated towards the upside here. So a lot of people saying this looks like a parabolic move, which has all kinds of implications. I think it's a little bit early for that, but I want to show you. This is a 10-year Treasury yield chart from 1965 to 2023. And Julie, you might remember the pink dots chart from the other day. Well, this is a little variation of it. If you take the number of times that the 10-year yield has surged more than 10 basis points in one day, you do that for each month and you add it up, all the way at the right-hand side, you're going to see, well, currently we have 4 of those events this month, and 1 of those is to the downside. What I want to show, and just a general impression from this chart though, is to show that this era that we're in right here is really a low era of low volatility in treasuries. We have seen some much greater volatility, especially in the late 70s and the early 80s. So all of this to say is there's a lot more volatility that could come if we get a surge in interest rates above 5%, and that's that big psychological mark. Does that really matter? Well, yes, because anytime we get a surge in rate with bond volatility, that spills over and it doesn't leave much room for other risk assets. I want to show you another chart on the Wi-Fi Interactive. This is a Nasdaq 100 going back to 1999 divided by US Treasury. So this is the tech to Treasury ratio. As high as it was in the dot-com bubble, around 5 there, it is much higher nowadays in the current epoch, and that is because not only is the Nasdaq 100 surging because of the mega caps that are outperforming, but also concurrently we have Treasury bonds underperforming, and in fact in that 3-year downdraft. You put it together with everything Powell said today, there's just increased uncertainty in the market, and Powell himself doesn't think that this latest rise is due to anything endemic of our future expectations of interest rates. So he might be on pause, but he might have to catch up later, or maybe he's done too much already. We just don't know, Julie.
Jared Blickley, I'll take it from here. Thank you, Jared.
All right, thank you.
Existing home sales falling 2% in September, hitting the lowest level since October 2010. Median existing home sales prices also marking its 3rd consecutive month of year-over-year increases. And while mortgage rates continue to approach 8%, further impacting affordability. Here with more on what's ahead for potential home buyers, we have First American Chief Economist Mark Fleming. So Mark, we kind of know the setup here, right? So on supply, we hear limited inventory, Mark. I mean, I'll tell you, here in New Jersey where I live, Mark, it's basically no inventory. Then on the demand side, affordability has just been crushed. I'm actually looking at the 30-year fixed, Mark, ticking a little bit above 8% here, according to Mortgage News Daily. Given those dynamics, Mark, where do we go from here?
Yeah, this week wasn't nearing 8%. It was surpassing 8%, and that was prior to today's moves. And so just what we were listening to in the last segment clearly is indicating that there's a lot more upward pressure to put mortgage rates above 8. But to your point, mortgage rates today actually impact both sides of the market. There's the obvious affordability crunch, makes it more expensive to get a loan and buy a home. But at the same time, since so many individual existing homeowners locked into such low rates, just a couple of years ago, they are not incented to sell. And so low inventory, even though there's less demand, and we still see rising prices.
I just keep reading the figure, Mark, that existing home sales are at the lowest since 2010. It feels just absolutely frozen out there. Is that how you would characterize it? And doesn't seem like anything's going to change anytime soon?
Yeah, 2010 was, the height of the global financial crisis. If you take the global financial crisis time period out, the last time we had home sales at this level was back in the late 1990s. So, getting below 4 is a rare event in modern, housing market history here in the U.S. Since, if the pandemic were the best of times for housing, then these are clearly recent worst times. And, Fed's saying it, like, we're going to keep it higher for longer. Higher for longer means the disincentive for those existing homeowners to sell is going to continue to be there. So it's hard to see how it changes anytime soon, meaning anytime in the next 6 months to a year. In fact, your prior guest was talking about when was the Fed likely to cut rates again? Probably not until 2025.
And Mark, you mentioned there that we're still seeing these rising prices. Do you expect that to change, Mark? You see that breaking anytime soon?
I think the more that rates have risen in the last couple of weeks and are continuing to rise, there's sort of more anecdotal evidence of further price softening because the demand side is really sort of catching up with the lack of supply. The months of inventory is ticking up a little bit, and that's the dynamic of even though there aren't many homes for sale, there are fewer and fewer people out there buying homes because rates are so high. And that's going to sort of slow house price appreciation a little bit more. I mean, we went from house price appreciation in the 10 and 12% year over year range to now, according to our index, of 5 or 6%. We could even see a little more softening, but it's hard to see big declines in house prices, just even slower growth.
Mark, can you talk to us about the bigger implications for the U.S. economy here with the housing market in this kind of shape? I mean, when you're looking at the GDP Now forecast for 5.4% this quarter for growth, I mean, that seems pretty good, last quarter, I should say. But is that baking in all of this lack of activity on the housing front?
Yeah, the housing market is a significant contributor, obviously, to overall economic growth. But the truth is, buying and selling of an existing home doesn't necessarily add too much economic activity other than real estate commission fees and things like that, or that we all like to go and buy new furniture and housewares when we buy new homes. And those segments of the market are certainly being impacted. The mortgage industry itself is certainly being impacted because not only are home sales down, but refinances are practically non-existent. But otherwise, we're not so large a component of the U.S. economy that we're a huge drag, although there is certainly a drag to less economic activity around the buying and selling of homes, particularly found in places like furniture sales.
And Mark, I'll get you out of this here on this question. I'm just interested to get your take on the rental market, Mark. What do you see ahead there in, let's say, the next 6 to 12 months?
Well, there was a benefit over the last couple of years in that since it was so hard to buy a home, then sort of people were remaining renters, even though they wanted to be home buyers. And the multifamily building industry responded by bringing along lots and lots of multifamily starts. Now, household formation has slowed down, and there's less demand for rental relative to the heights of a year or two ago, and vacancies are rising. So the multifamily market is softening, and in many places, rents are coming down from the highs. That's mostly driven actually by a slowdown in new, young Generation Z households forming.
Mark Fleming, great to get your perspective on this. Hopefully things start to pick up a little bit, but we'll see. Thank you.
Thank you.
Coming up, subscription fatigue is about to get real. A new survey says every person will have 6 streaming subscriptions by 2027. And we'll talk to you about super users next. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean
for you.
Keep it tuned into Yahoo Finance.
Netflix shares riding high today after reporting a surge of nearly 9 million new subscribers, as well as beating on the top and bottom lines. The company also saying it will raise the prices of its subscriptions again, following suit of many streamers. All of this coming as new research shows that within the next 5 years, each person is expected to have nearly 6 media subscriptions. That's one of the many findings from Activate Consulting's annual report. Its founder and CEO, Michael Wolff, is joining us now. Michael, you and I have not talked in a very long time, so it's good to chat with you. Talk to me about these streaming, services that people are going to have. And are we talking about just streaming? Are we talking about media of different kinds? What is that portfolio for individuals going to look like?
Yeah, it's interesting. We've been looking at this for about 9 years now. And 9 years ago, if you look, the average consumer was subscribing to 1.7 services. Today, we're up to 4.9. And we're forecasting it's going to be close to 6 within 3 years. And these are paid streaming services. It doesn't include the free subscriptions for Tubi and Pluto and others that are called fast services. But we are seeing the market. What's happening is Netflix and others, they're all moving to, they have an ad tier, they're putting in an ad tier, and they're raising their prices. And what's slowing down is the churn in these customer bases. So, and finally, people are coming, but they're coming for the originals. And when all these companies say they're going to cut back on programming spend, in reality, they don't have any other choice but to continue to spend on programming.
And Michael, I'm also interested in how much sports is driving all this. If live sports rights, if you own those, it seems to me you're in a great spot. Everybody wants them, including Apple, Amazon, Google. What's sports role here?
There are a couple of things that are happening there. One of them is the streaming services are now going to take some select games or some select nights. And I think that's going to be one of the things that's going to be driving interest to their services. In addition to that, ESPN has a very strong direct-to-consumer offering. It doesn't have everything yet, but I would expect it would. And finally, we have all of the local games. We don't know where they're going to go because a lot of the regional sports networks are doing very badly, and including one of the groups, Diamond Sports, is bankrupt. So I think that we should expect to see this. And one of the things, if you look at, we publish our annual technology media outlook, and it's on our site, activate.com, but you can see the raise in prices and also the tremendous amount of interest of how many rights are going to go to the streaming services.
Well, and then, of course, there is streaming versus other ways we spend our time. Of course,
right.
This is something that we've heard about from Netflix, which says, everything else is its competition, effectively. You guys put in your report an attention clock, which I sort of find depressing because things like sleep get about 6 of that, and all of this other stuff is sort of crowding for our attention here. Are our screens going to take up a larger and larger proportion of this attention clock?
Screens are going to take up a larger portion. Audio listening is going to take a larger portion of it. It is crowding into two things. It's crowding into work time and sleep time. And so, and we believe, so if you look at our attention clock shows, on average, because of multitasking, the average American is spending around 31 hours a day with technology and media. And that is good. About 13 hours a day is entirely on technology and media. But if you look at it over time, it was around 12 a day before the pandemic. It jumped up until around 13, and it's going to continue to go up. We're forecasting by 2027, it's going to be close to 13 and a half hours a day, 13 and a half hours a day of attention with technology and media.
And Michael, those super users that you're talking about in your report there, any details on the demographics of those super users, Michael, how that breaks down? I mean, who is the super user by age, men versus women?
You know, it's all over the place. I mean, there's just no set rule. People always imagine it's 18 to 34-year-olds, but it's really all over the place. And some of it just depends on the things that they're interested in. So we find, for example, that 24% of all users of all super users account for over 50% of e-commerce purchases, or over 70% of all video gamers. In some cases, they're exactly the same people. It's just these are people, and the numbers, what we look at is 24% of all users account for 18 hours a day of multitask time, and that's compared to 9 hours a day for all other users, for that other 76%. So, and this is a phenomenon. I mean, we're going to expect that everybody in the technology and media business, as well as in e-commerce and other areas, we expect this is the group of people they're going to focus on. We're highly penetrated now in terms of video and in terms of streaming services and internet, and now it's going to be focusing on the most valuable users.
And so how do they get those users and keep those users, Michael? Presumably this is where you come in and what these companies turn to you to figure out insights on. I mean, presumably then the battle for these users is going to be really tough. What is going to make the winners stand out here? What are they going to need to do?
Well, our annual report is based on very large consumer research studies as well as industry analysis. And part of what we've been doing for every business we work in is really understanding what are the triggers, what gets these people to consume more. And also, what we do know is that people who are super users in one area, they are super users in another. So if somebody's a super gamer, then they also tend to be people that go to concerts. So it's finding them, identifying them, and understanding what gets them to move. How do you get them?
Michael Wolff, thank you so much for your time and insight today, Michael. Appreciate it.
Great to be here.
And coming up, the price of pills. Pfizer setting the price for its 5-day course of the COVID drug Paxlovid. Find out how much it'll run you next.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Pfizer is setting a high price for a 5-day course of the COVID drug Paxlovid. It's more than double the price that the U.S. government has previously paid. That's according to the Wall Street Journal. Yahoo Finance's Anjali Kamlani is here with the details. And to put this in perspective for us now, the U.S. government just said it was selling back or giving back these doses to Pfizer. So now we're learning what it's going to be charging for them.
That's right, Julie. And to put this in perspective, also, there were estimates from analysts earlier this week on what that potential price could be. And this falls under that sort of high that they had been looking at, more than 2,000. So right now, the cost looking at $1,390 per 5-day course. That is the list price. So the actual price will vary for individuals who have insurance and what that out-of-pocket cost will be. Pfizer is saying that they're working with these insurance companies to figure out what that could end up being. This does reflect, like you said, a more than 2x increase from what the government had been paying. But these courses are going to stay free through the end of 2023. And Pfizer has noted in a statement to us that it is also going to remain free for those on Medicare, Medicaid, and the uninsured through a government program that they are sponsoring. Meanwhile, we're also wondering, what that copay is going to be for ourselves as patients if need be. But in addition to that, there will be a program where some eligible patients could qualify for a $0 copay as part of another program that they're offering. So while that list price is quite high compared to what it was before when the government was distributing, Pfizer says that they are looking at this as really a market opportunity with more avenues for distribution for this. And like I said, it came in a little under what the anticipated sort of analyst numbers were. So we'll have to see how this all pans out once Paxlovid is on the commercial market.
All right, we'll keep watching. Anjali Kamlani, thank you so much. And activist investors lining up in recent days, launching a series of new campaigns, from Nelson Peltz's Trian Fund Management, reigniting its Disney proxy battle, to VF Corp feeling the heat from activist investor engaged capital. So what is the trend behind this bustle and shareholder activism? Here to discuss is Patrick Gadsden, Vincent and Elkins, co-head of the shareholder activism. So let me ask you, Patrick, just to start with, what explains these trends we're seeing here, Patrick? Is it falling public equity values? Is that what explains it?
Well, I think those are two different buckets, right? So for Disney, this is second wave activism for them, right? This is the sequel the board didn't want. So it's slightly different than VF Corp that's dealing with activism really from engaged for the first time. Obviously, undervaluations always drive shareholder activism, and we've seen a lot of that over the last few years. But we're actually not seeing more shareholder activism exponentially. We're seeing pretty stable growth in the asset class year over year. It's just we're seeing very name brand or collection of name brands in the case of VF Corp, activism happening in the public space.
So, Patrick, that implies then that there isn't necessarily anything special about this moment in time. It's just sort of activists being opportunistic.
It is. I'd say that Disney, in a way, is special, right? It's not very frequent that you see shareholder activism at a huge brand name Americana company happen in back-to-back years, right? That's very, very rare to happen. One of the reasons it's very, very rare to happen is because the sort of metrics and means of affecting change are not the same, right? So the first time a shareholder activist is encountering a company, you make your case for change from the shareholder activist perspective. It's usually 1 to 4 prongs, as we saw with Tryon and Nelson Peltz, and it has a lot to do with always, operations, strategy, capital allocation, governance. After you've done that, if you aren't successful, the company has a year to work on all those things, right? As we've seen Disney do. So it's much more difficult to convince institutional shareholders and proxy advisors who make the recommendations that are followed by the larger institutions that additional change is necessary, right? I mean, you've had enormous cost-cutting programs announced by Disney. You've had the streaming business very much sort of cut in terms of its budget and its overhead. And then you've also had some wet blankets thrown on the stock over the last few quarters, right? When you see announcements like we saw last night, where, over the course of the past few quarters, Disney's profits have declined 20%. Obviously, shareholders are not going to love that, and that's probably why the stock's down 30% since the announcement of the reorganization and cost-cutting plan. So it's a very unique circumstance when you have a lot of changes that were actually done in the wake of activism, married to brand new circumstances and quote-unquote issues or problems that Disney's had to deal with, including the labor disputes, including, the tiff that got in with Charter. So it's very unusual you'll see something like this in shareholder activity.
And Patrick, what about ESG? Is that still a focus for activists, or has that cooled a bit?
That's a really great question. So over the past decade or so, it was sort of taken for granted that ESG was something that not only all institutions should be advocating for, but that all public companies should be striving for in order to soothe the concerns of those institutions at home, right? Over the past couple of years, the willingness to lean into that has obviously changed, right? And a lot of that has to do with the political lens, right? The anti-woke sort of crowd that's risen up to push back a lot of what has been some significant progress in the ESG space over the last few years. So I wouldn't say it's gone away. I'd say that empirically, what you're seeing is fewer companies sort of be, more broad-breasted in mentioning it in their proxy statements as frequently and in their public communications. You're not seeing that quite as much. But it's not something that companies are fully walking away from, right? Because we haven't seen the institutions, the BlackRocks, the State Streets, be willing to sort of totally tone down their rhetoric in terms of it being a desire for companies to pursue strong ESG policies. If we actually did see that, right? If we saw the shareholder bases of, we call it, the S&P 500 at large, rise up and say, hey, we think that ESG is a direction that we no longer want companies to go as shareholders, then we would see, probably pretty aggressive change and repivoting. But we haven't seen that from the larger institutions. So from the company's perspective as well, unless you're going to tell us this is no longer something that you want us to pursue, we're going to assume that it's something you do want us to pursue, and we're going to consider sort of the pushback from the more sort of anti-ESG, anti-woke crowd to be more of a minority group of our shareholders, as opposed to a set of voices that reflect the broader shareholder base.
Gotcha. Helpful context there, Patrick. Hope to catch up with you again soon on all of these issues. Patrick Gadsden, thank you.
Thank you.
Coming up, the closing bell on Wall Street. We'll be checking on the latest market moves and the top trending tickers as we see selling into the close. There you have the closing bell on Wall Street here. So let's do a check of the markets. We saw stocks falling here, quite a lot of volatility over the course of the session. But when all was said and done, the Nasdaq off by almost 1%. The S&P closing down by 0.9%. The Dow off 250 points or so. That's about 0.75%. Take a look at the Wi-Fi Interactive, because here's that volatility that I was talking about here. When you're just to take the Dow as an example, a lot of this, of course, centering around Jay Powell speaking at the Economic Club of New York today, taking questions as well. And as Kevin Nicholson of Riverfront told us at the top of the show, not giving a lot of clarity here. Yes, he did talk about the Fed having room to continue to pause here, but at the same time, he talked about the data not necessarily supporting their continuation to be able to do so. So on this, when we talk about volatility, you also saw quite a spike in the VIX here, up to 21 in today's session. We also have been watching bond market volatility. That one's not working for me, but if you look at the 10-year here, seeing very close, within a whisper, within a hair's breadth of 5% on that 10-year yield. So how did all of this translate into the groups, sectors in the S&P 500? Everything was down, first of all. Consumer discretionary taking the worst of it today. Real estate, financials, materials, healthcare, also all lower in today's session. And I want to take a quick look at the Nasdaq and what we saw there, because, of course, we had some news on various Nasdaq companies. Tesla shares ending the day down 9% following their earnings report after the close yesterday, and a conference call that was not really welcomed by the investment community. Gross automotive margins at Tesla missing, the Cybertruck production path going forward, not getting a huge vote of confidence from Elon Musk. So those were a couple of the areas with which investors seem to be disappointed here. And I'm just going to equal weight it real quick here, because all the way on the upper left, we got Netflix. Those shares finishing higher by 16% on the day. So that definitely helping in some small measure, but Netflix is better than estimated subscriber growth helping matters. In terms of some other movers that we were watching today, Philip Morris, those third quarter earnings beating expectations as the company boosted its profit forecast, but a lower than expected full year outlook on shipment volumes for its heated tobacco products did dampen investor sentiment. The shares down 2.7%, and heated tobacco is one of the areas that Philip Morris has really been trying to diversify in. Philip Morris has been trying, believe it or not, to move beyond cigarettes, traditional cigarettes, into these alternative tobacco products. So if that area is not going great for them, you know, that's why it's drawing some questions here.
Yeah, even as sales of cigarettes, by the way, I'm reading here, apparently holding up better than expected. They declined just about 0.5%, and the street thought it would be a lot worse. And to your point, though, a lot of the focus was on these alternatives, right? And so that seems to be what investors are focused on. Even as nicotine pouches are apparently very strong, the heated tobacco sticks not as strong as some hoped, and that's bringing them down.
Yes, heated tobacco sticks.
Right.
Never thought you would talk about.
No, I had to look that one up, if I'm being totally honest. Yeah, I searched for that one. Let's move on. Shares of VMware diving. Beijing reportedly weighs delaying the approval of Broadcom's acquisition of the cloud software company. This, according to the Financial Times. Delay in approval of that $69 billion deal would come in the wake of Washington's tougher chip controls. So this one was interesting, Julie, because remember we were talking about this. It started off as kind of just a rumor. Yep. People weren't sure. Well, maybe this is how China hits back at Biden's new export controls. But now the FT is weighing in here, and that's giving it a little bit more credibility that, yes, the Chinese government really could block this planned mega deal with VMware. Apparently, Chinese regulators now considering whether to delay that. We did recently, remember, we spoke to Stacy Rasgon, who is the chip guru over at Bernstein. Stacy still really likes Broadcom. He's a fan, and he's not alone. About 75% of analysts still rate this one a buy.
Right, and he said even if the deal doesn't get completed, which is an important sort of caveat there. So when we're looking at this and we look at the reaction in the two stocks, clearly investors see similarly that VMware has a lot more to lose than does Broadcom if this deal does not go through. Broadcom has been holding fast to its timeline here, saying the deal will close by the end of the month. So, I guess we have to wait until the end of the month to see if all of this other stuff is just chatter and speculation and reporting on possibilities versus reality.
And we should mention, yes, Broadcom dipping in today's trade, but this one has been a rocket ship.
Yeah.
It's up about 55% this year.
Yes, great point. Sticking with what's going on in China, let's get a check on Baidu as well. Feeling the pressure, several analysts slashing estimates and price targets on the stock ahead of its quarterly results. This coming amid concern over weakness in China's advertising market and the company's cloud business. And we've seen the likes of JD.com suffer similarly here. So a lot of concern over the consumer in China, about advertising demand in China and what's going to happen. The company is set to report, unclear exactly when, sometime in November. But clearly, we're seeing a lot of analysts sort of brace themselves for those numbers.
Yeah, it looks so. The street is definitely, they're busy cutting both estimates and targets. It's weakness in the Chinese ad market they're worried about. They're clearly worried about the cloud business as well. For example, J.P. Morgan, and listen, they're still overweight the name, but they did tell clients Baidu is dealing with downside risks. They call it a weak Chinese e-commerce sector. They cut their target to 185.
Yeah, it is interesting that a lot of this is indeed target cuts, but not downgrades.
Yeah.
To your point, a lot of these analysts I'm looking at, it's not just JP Morgan, HSBC is still a buy on the stock, Citi is still a buy, but they are cutting those price targets. So we'll see what ends up happening.
We'll watch it. Moving on, shares of Tesla have gone off-road today following a disappointing earnings report, missing on both top and bottom lines. The company's cost-cutting efforts have been attributed to the downward pressure on margins. But our reporter, Ali Garfinkel, says the lack of growth in recent times may be down to an overlooked competitor putting the brakes on Tesla in biggest EV market globally. Ali, over to you.
Hi, Josh. So Tesla's meteoric rise has always been about the promise of growth. But one key linchpin to that growth might really be slipping away here, and that linchpin is China. Now, it's hard to overstate the importance of China in the global EV market. In 2022, China accounted for 60% of global EV sales. And instead of making progress there, Tesla is actually losing ground in China. Tesla's market share in China has been on the decline, falling from 15% to 10% from 2020 to 2022. And I've sort of identified two key reasons that Tesla's really been lagging in China. The first is competition, which is subsidized heavily by the Chinese government. We do know that on a geopolitical basis, China has been very interested in owning the EV market. And that means they have really helped bolster competitors like BYD, which has really specialized in affordable EVs that are made specifically for the China market. The other thing to consider is Tesla's really had some self-inflicted wounds. There's really no other way to say it. Remember, China is a key market, and it is also a market where people are making less than $10,000 a year for the average urban worker, which means Tesla price points might actually not be ideal. So affordability is going to be a key problem for Tesla moving forward in China. There's an incredible story in Walter Isaacson's book about Elon Musk really being interested in the robo-taxi and pushing aside the possibility of pursuing a Tesla that was maybe around $25,000, $30,000. And you have to wonder if that's a decision that, especially in light of yesterday's earnings, that Musk would make again today.
I wonder a lot about those decisions. But beyond China, talk to us about market share in the rest of the world for Tesla.
It's a good question, Julie, and it may be unexpected, but the best jumping off point for having that conversation is actually talking about the U.S. Now, Tesla has been known for its dominance in the U.S. EV market, but that dominance has been trending downward. In 2020, Tesla's grip on the U.S. EV market was 79%. Today, that number is 58%. Now, especially amid that sort of dwindling dominance in the U.S., comes from more competition, of course, but it also makes these emerging markets like China that much more important. India is another emerging market that we know Elon Musk is incredibly interested in. But that said, I've had a lot of experts tell me that, again, because of these affordability concerns, Tesla's not necessarily set up to succeed in India either. So for Tesla, what I would say is right now that race for global dominance is still far from won.
We will count on you to keep tracking it for us, Ali. Thank you. Well, from Silicon Valley to D.C., the Republican Speaker nominee Jim Jordan has said he will not back a plan to empower Patrick McHenry as a caretaker Speaker of the House, despite reports coming from Capitol Hill saying he would earlier today. Instead, he's going to push on with his run at the speakership despite losing 2 rounds of voting already. It comes as both men face mounting pressure to get Congress moving again to provide funding to Israel and Ukraine and prevent a government shutdown. Rick Newman, senior reporter at Yahoo Finance, is here with more. Oof, is he a glutton for punishment or what? Or is there a chance? Is there a path somehow for Jordan?
3 blind mice, see how they run. I just want to sing a nursery rhyme. I mean, it's 3 blind mice. Jim Jordan, Steve Scalise, and Kevin McCarthy. They're just like walking around or running around or scurrying around in a dead end. They're going absolutely nowhere. This is just farcical. I mean, we're all trying to figure out what's the logic behind any of this. I think the only logic is to everybody just wants to stay on the camera as long as possible. Like Jim Jordan lost. He lost once. He lost worse a second time. If he does it a third time, he's going to lose even worse. But he can't step down. I don't know what is the problem, but we do know that what has happened within the Republican Party is that the obstructionists basically gain control. The lunatics are running the asylum. And this is what it looks like when obstructionists have power. They cannot do anything at all. And meanwhile, the clock ticks.
So, Rick, give me the Rick take, though. What do you think actually plays out here, if you were to bet?
There has to be some kind of outcome. Maybe this is all part of a process that gets to this idea that seems to be the sort of only serious way out of this at the moment, that we have an interim speaker pro tem, which is Patrick McHenry, who actually becomes the permanent speaker pro tem, or at least the official temporary speaker pro tem, and then they can change the rules so that he actually is able to bring legislation to the floor and do some of the normal things that a speaker does. But the catch here, and I think the reason that we're just seeing this folly among Republicans, is that in order to change those rules, you have to assume that the Republicans will not get all the Republicans to vote for that way out, which means you need some Democrats. And Democrats are not going to say, sure, we'll be happy to save the Republicans from embarrassing themselves any further. The Democrats are going to say, here's what we want in exchange for letting you guys off the hook here and allowing it to go forward with a temporary speaker pro tem. And that is going to turn off more Republicans. So it is possible that we sort of get this coalition of moderates at some point, but Republicans are just in no hurry at all to save themselves from looking absolutely foolish. So this might end up coming a lot later than anybody thinks this way out, which means maybe just a couple of weeks before we hit that deadline in mid-November when the temporary spending bills expire.
And Rick, we have to talk about Biden as well here. We know he's going to be making that national address this evening following that trip he made to Israel. But he came home to some unfortunate polling by Bloomberg that found his economic ambitions, Rick, aren't convincing some very important key voters here.
Right. This was a look at voters in swing states, and their approval of Biden on the economy is now below 30%. And you can, on one hand, you can scratch your head and say, the economy is really not that bad. I mean, voters are basically saying, we think the economy is in a deep recession. And it's clearly not. I mean, we have positive economic growth. We actually have strong economic growth. The job market is strong. And the real reason for this, and what we may have forgotten, or maybe it's a little bit new, is inflation freaks people out. And now rising interest rates are freaking people out. Economists tend to look at this on historical trend lines, and, to have the 10-year Treasury at about 5%, that's very high for the last 15 years, but it's not historically high. It's almost about average on a historical basis, and the historical average for mortgage rates is about 7%. It's a little above that now. So on a historical basis, we're not really that high in terms of interest rates, but in terms of how fast we've gotten up to averages from record lows, I mean, I think this is just shell-shocking consumers. And they look at, they're hearing mortgage rates at a 20-year high, 30-year high, all these other things happening. Inflation still hasn't come back down, and they just are freaked out, and they aren't really sure why this might be Biden's fault. They just think it is.
All right, Rick Newman, thank you for joining us today. Appreciate it.
Bye, guys.
And coming up, we're going to hear about the state of the digital ad business ahead of that 2024 election cycle. That is next.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
The advertising business is facing a bit of a slowdown this year as companies rein in their budgets. But are we in for a rebound heading into 2024, especially with the presidential election? Our next guest has key insight as hundreds of Fortune 500 companies use his company's data and analytics to drive ad effectiveness. Joining us now is Double Verify CEO Mark Zagorski. So, Mark, let me start with this, just your 30,000-foot view, Mark, of that digital ad market. How healthy is it right now, Mark, and what do you see ahead the next 6 to 12 months?
Yeah, I think this year has been a story, tale of two different ad markets. The year started off pretty rough with Ukraine and interest rates dragging on the business. I think we're ending the year with a slightly more optimistic tone, despite global kind of challenges that are out there. You've got an election year coming up. You've got the continued explosion of short-form video, retail media networks, et cetera, that are driving ad demand. So I think from a macro perspective, things will look a lot better at this time of the year than they did last year at this time.
Mark, what are the big structural changes you've seen in the ad market sort of pre and post pandemic?
Yeah, I mentioned a few of those. The first is, one of these things, the emergence of what's called retail media networks. So a lot of the folks that actually are in the business of selling stuff, so Amazon, Instacart, Macy's, retailers, actually using the data about those sales to build ad businesses. We've seen everyone from Uber to, as I mentioned, Instacart get into the ad business. I think that's one of the changes that we've seen since pandemic. And I think the other big ones really have to do around video and the consumption of video. Both the emergence of connected television, and Netflix has been really in the news this week about how they are focusing on advertising, and the consumption of video in short form, driven by TikTok, but now also, folks like Meta Reels and YouTube Shorts getting into the short form video game. So, lots of changes have attracted totally different ad dollars into the space and changed the way people are engaging.
And Mark, how much of an issue is fraud still when it comes to digital advertising?
Yeah, fraud is something we know really well. DV's been in the business of rooting out fraud for over a decade. We've got a committed, team of folks in our DV fraud lab that look for things for bad players. And to be direct, it's one of these things where it's a game of whack-a-mole. Once we find one fraud scheme and look to eliminate it for our customers, another one pops up. It's pervasive, and unfortunately, the emergence of AI tools and the growing implementation of AI in the digital ad space has only made the fraudsters more aggressive and given them, more powerful weapons to go out and try to steal ad dollars from legitimate advertisers.
And then what are the implications of that as well, not just when it comes to ad fraud, but to misinformation more broadly?
Yeah, there's an interesting connection between, and especially as we're talking around election season, between fraud and misinformation and disinformation. A lot of the fraud that we see is perpetrated is not some kid in his basement trying to steal a few bucks from a big brand by, misdirecting ads. These are pretty sophisticated criminal enterprises. In many cases, they're funded by groups or governments that are looking to use that money that they steal to build fake profiles, fake social media profiles, and propagate more misinformation and disinformation. So there's a connection between the criminal element of fraud and the actual, continued, preponderance of misinformation and disinformation, particularly when it comes to election seasons. And we saw this 2 years ago during the U.S. midterms, and we expect to see an increase in both areas in the next 2 years around the 24 elections.
Mark, for advertisers, I'm curious to get your take. Are there too many social media platforms at this point? You've got, X and Threads and TikTok, list goes on. Too many options?
Advertisers, there's two people that will determine if there's too many options: consumers and advertisers, right? If consumers start to shy away from one platform or another, the ad dollars will then follow them, to places where they're going. I think right now consumers are still trying to figure out what works for them. I mean, you have Threads, which was recently launched. You have an increasing number of short-form video platforms that are out there. They're splitting their time, but I think with everything, with all emerging media, you see an explosion of different channels and then a consolidation. We've seen this across connected television. I think we're going to see it across social as well over time. There's only so much content consumers can consume, and there's only so many places advertisers can spend. So I think we are probably ripe for consolidation at some point in the next 18 to 24 months.
Mark, where are advertisers, on what platform are advertisers getting their best ROI right now? And what does that look like? In other words, how do they measure that?
It's, I hate to be, very broad, but it depends. Advertisers, some are looking to drive brand awareness, some are looking to actually drive an acquisition of a customer, and some are looking to drive product sales. And depending on that ultimate goal, different media is working different way. And I think that's, the question previously is directly related to that. What they're finding is certain social platforms, so short form video, for example, across TikTok or Meta Reels or YouTube Shorts, works really well for brand lift and brand awareness because it's sight, sound, and motion. But we're seeing other platforms such as traditional social and traditional ads, banner ads, impressions work really well for client acquisition because they're cheap and you can spread a lot of them out there to drive direct responses. So I think it still depends on what the advertiser's goal. One thing that is clear is advertisers are getting much better at kind of closing that loop and tracking what's working for them. And you're seeing dollars shift very quickly to areas that work well.
Mark Zagorski from Double Verify. Mark, thank you for stopping by.
Absolutely. Thanks for having me.
And coming up, we'll go around the horn with today's top stories, including unveiling ESPN's annual profits for Disney. That's after the break.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal here with Madison Mills and Josh Schaefer. And guys, we're going to kick things off with Disney because for the first time ever, we now have a revenue breakdown of how ESPN is doing. Remember, in February, Disney restructured its business into 3 new segments. So one is entertainment. That includes movies, TV, streaming services like Disney Plus, Hulu. Then we have sports, which is all ESPN, ESPN Plus, and then a tiny portion of that is the Star India business, about 5%, and then the park side of the business. So here's what we learned about ESPN. According to that SEC filing, ESPN generated more than $16 billion in revenue and $2.9 billion in operating profit in Disney's fiscal year 2022. What you're seeing on your screen now is the 9 months ending July 1st, 2023. Now, what we did find out from that recent data is that sports revenue is trending down about 1% over the past 9 months. Not so great, analysts have said, but still better than linear networks, which is down about 8.7% on a year-over-year basis. So just interesting to see where ESPN stands, especially as Disney and CEO Bob Iger are searching for that strategic partner to bring ESPN fully over the top. When you think about buyers of the asset too down the line, this is important information to know.
Yeah, I mean, couple analysts out on the street saying it certainly made Disney look or makes ESPN look attractive when it comes to that acquisition. Another interesting thing I think too is when you take that $13 billion number that's on your screen right now, just over $1 billion of that came from ESPN Plus subscriptions. So not a major portion of how ESPN is currently making money is coming from subscriptions. That's because a lot of what ESPN was doing for a while, it was like a $6.99 product. It's up to $9.99 now, but they really want to push for that a la carte, putting sports and putting a lot of games on streaming and maybe making it $29.99 was one of the numbers that have been rumored out there. You have to think by looking at the financials, that move would make sense and sort of change the streaming product as we know it. For it to be $30, that's more expensive than the $23 I won't pay for Netflix.
I mean, that's such a good point, Josh. It makes me wonder, too, from an analyst perspective, does ESPN come out of this looking like such a cash cow for Disney with that top line number, or does the kind of decline in subscribers make you question whether or not it is the best buy? We were talking earlier about whether or not an Apple gets in on the ESPN play, and I remember talking to Dan Ives about this. He said it's a no-brainer for Apple to come in and pick up ESPN, but I have to wonder whether if you're Apple and you've got this great cash flow, they've been able to stick to the same Apple story for so long, do they want to risk it on ESPN when the numbers are starting to decline a little bit?
Yeah, and look, based on these numbers, you know that ESPN revenue, it makes up about 20% of overall revenue for Disney. So that's a pretty sizable chunk. You mentioned how subscription fees, not a big factor there, but what is a big factor is the affiliate fees or the carriage fees. That was at the center of that big dispute with Charter. ESPN historically has charged the highest amount to pay TV providers, and you're seeing that in the numbers. That's bringing them a lot of revenue, a lot of money. So when they do make this full transition to streaming, how are they going to compensate for that? They're going to charge the consumer, and that price is going to be pretty expensive.
And how high does that price
Probably
get?
$30.
When you go to the bidding table for NBA rights in 2 years, and that deal could be $75 billion. I think at some point, we're going to at least start to see how these sports streaming costs and how big they've gotten for companies. You're going to get a great look at that now by being able to see ESPN's financials.
Right, and to your point, everything is just getting more expensive, even with streaming. Another thing potentially getting more expensive is your flights, okay? We've got a great story today about United. The window seat is going to board first for the basic economy ticket holders. So groups 1 through 3, they're going to board the same order that they have been traditionally, but now 4 through 6 boarding groups, that is going to be window seaters first, followed by middle seat, and then aisle seat is going to be last. And Allie, you asked the great question earlier today about the carry-on bag. That is the only reason that I am in line first. Right. I'm that loser who is there first to get on because I don't want to check my bag. You are going to be negatively impacted if you're the aisle seat holder because window and middle will be on first.
Which is fine because the window seat's the best seat, so it doesn't matter, right?
The aisle seat
because the window seat you get to sleep and you put your head against the window and it's great.
I am tall. I like to stretch my legs out. I don't like to be cramped in the middle seat or the window seat. I go aisle every time.
No one likes the middle seat.
If you look at the numbers on how sometimes you have to pay out of pocket to select some of these seats, the aisle seat's always the most desirable, in my opinion. I love the aisle seat. And I'm very upset now that I might have to check my carry-on bag if there's no more overhead space. And quite a lot lately. They have run out of overhead space. And if I'm the last person to board, that's so
So
frustrating.
you sound passionate about this. It
I'm
seems
very
like
passionate.
you would almost sign up to be like United Plus Rewards member or something like that to maybe fix that issue, right? So
Well,
maybe a
that's
smart
probably the
play by
whole
the airline
point,
to help their loyal customers, right? And then the people that just fly basic economy and don't fly that much end up being the ones that sort of have to have the less enjoyable experience.
But to Allie's point, the issue is that you already would have to pay to even pick a seat in general. And then within basic economy, even if you want to say, okay, I'll pay a little bit more to pick the window, you're still paying an upcharge on that original cost. So it's just a lot of these little hidden fees, which also, as we know, Secretary Buttigieg has been working with the airlines to try and decrease some of these hidden fees. I do want to mention the stock price. If we're looking at the macro picture, we're getting a lot of the airline earnings in over the past couple of days. If you look at United struggling after their earnings, there was a beat there, but you can see the stock going down earlier today and throughout the week. That is because of the conflict in the Middle East, bringing up those oil prices, and this has been something that's going to weigh on the profits for all of the three major airline carriers. You've got United, Delta, and American Air on your screen there.
Fuel prices up. Charge me more to sit in the middle seat, the window seat,
Basically, I'm
the
just
aisle
not going
seat,
to
right?
travel anymore.
Just charge. We gotta pay. We gotta pay somewhere, right? Someone's gotta pay. It's usually gonna be us.
It's going to be the consumer.
But there is one great thing coming for the consumer.
Oh,
If
yeah?
you want to stay at your house and get your medication delivered, Amazon is offering it for you. Great story out today from Amazon. Amazon Pharmacy now doing drone delivery. So the way this works is you can receive medications. They're delivered in 60 minutes or less. This is currently, they're testing it out in College Station, Texas. Some college football fans like myself might think Texas A&M, so maybe some college students or that big campus sort of area enjoying this perk. But really pretty interesting here, guys, to just think about Amazon's capabilities, right? To think that you can get a prescription delivered straight to you is just the power of Amazon, and it's something I feel like only a company like Amazon could do. Allie, we were talking earlier this week about Rite Aid's bankruptcy filing, right? And sort of how some of these pharmacies just haven't been able to innovate at the level of a company like Amazon. Rite Aid was never going to bring you your prescription with a drone.
Yeah, when we were talking about that, we were saying how convenience is the number one thing for consumers. Rite Aid also closing a lot of stores. If I am a Rite Aid consumer and I need my medication, but I'm traveling and I can't easily access a Rite Aid, that's going to be a concern. And here with the drones, very convenient for the consumer. Literally comes right on your doorstep. And they're doing that with regular products, right? Or they were thinking about doing that.
I believe they're also getting into drone delivery beyond prescriptions too. Yes.
Right, because that's something that I would be interested in as well.
Of course.
Yeah.
Well, and a huge cost cutter for the company, right? Think about the labor costs they'll be able to cut down on. I know, Josh, you like to get out of the house, but I feel like Allie and I are maybe more on the same page.
I would not be getting, if you have a prescription, you probably kind of need it. Are you really going to trust the robot to bring it to you? I'm not there yet. I'm skeptical.
But it comes in under an hour, right? I mean, that's
Yes.
if you're
crazy.
really sick, if you have the flu.
I guess it's a good point. It's a good point. You could stay put and it actually could come quicker.
And I will also say, I was very sick a few months ago and I needed a prescription. I went to my local Duane Reade. It was my first time going there. My doctor called it in about a half hour before they closed, and the pharmacist told me, I'm sorry, we can't give this to you. We're closing in a half hour. And I said, I am sick with a 104-degree fever. And they said, well, you're going to just have to wait till tomorrow. And I would have liked that Amazon drone delivery service because then I could have gotten my medication.
Crawl out of your bed, grab it, run back inside.
No one wants to trek out to any type of pharmacy when you're not sick. So I don't know. I'm on board with this. I know you're skeptical.
I just love stopping in the store. I can't wait to just stop in a store on the way home, pick something up. I don't trust the robots.
Okay.
Because why? They're going to surveil your house?
Yeah, you don't want them near your house, and then what if they lose your stuff?
Right.
Well, guys, I got to go because it's going to take me a while to get home because I got to stop at a couple stores. But we're going to have more Yahoo Finance Live on the other side. Stay tuned.
Treasuries are on a roller coaster of sorts lately. There were geopolitical tensions pulling down yields as investors flocked to safe haven assets, but mounting fears of higher for longer rates are driving yields to multi-year record highs. The 10-year approaching 5%. Earlier, I spoke with Mohamed El-Erian, Allianz chief economic advisor and president of Queen's College in Cambridge. We talked about the moves in the bond market and the impact to the economy.
The immediate cause for the latest leg up is news that China reduced its holdings of treasuries by 21 billion in August. And that speaks to bigger concerns that people have, which is where are the buyers? We know we're going to get a lot of issuance by the government, but who's buying? The Fed is not buying, the Fed is selling. Institutional investors, a lot of them are underwater already. Their appetite to buy more here is limited. And there's been questions about China buying because of geopolitical issues. So despite what's happening in the Middle East, yields have been going back up. As to what it means, well, for the everyday person, it means a mortgage rate on a 30-year above 8%. It freezes the housing market even more. It means higher borrowing costs for both households and businesses. So it's not good news for the economy. But the biggest concern out there is the violency of the move, the way we've gotten to 493 right now. And there's a fear, and I hope it's just a fear, that this could break something. And it's important because we have no anchors. Fed policy is no longer an anchor. Fed policy is too backward-looking, is too data-dependent, so there isn't clarity on where we're going to be when. And the economy is no longer an anchor. So this is a really hard time for the bond market, and we need stability. We desperately need stability.
Well, where the heck is that going to come from, Mohamed? As you say, the traditional buyers of treasuries maybe are backing off, or they're at their limit, right? Even if they're still in the market here. What do you want to hear from Jay Powell today? What could he possibly say that would provide that stability?
So what I want to hear from Jay Powell is not what we're going to hear from Jay Powell, just to be clear. What I'd like to hear from Jay Powell is that we are no longer excessively data dependent. We recognize that you cannot drive a car that is on a curvy road looking through the back view mirror. That is what data dependency does. And when your Fed tools operate with lags, it becomes a problem at points of inflections. And we are at 2 points of inflection here, a technical point and an economic point. So what I would like to do is greater vision from the Fed, as did the Yellen Fed, as did the Bernanke Fed, as did the Greenspan Fed. This is the first Fed that hasn't got a single strategic bone in it. It's all data dependent. And if it were data dependent, to be clear, Julia, jobless claims below 200,000, certain inflation outcomes above. Atlanta GDP for the third quarter is in the 5% range. If they're truly data dependent, we're going to get a hawkish message. And the last thing this market needs is a hawkish message right now from the Fed.
The backdrop for all of this, of course, and you're out with a book recently called Permacrisis, which looks at how to attack some of these issues that are persistent and consistent in the world. And I'm reminded of what Jamie Dimon said last week, that this is one of the most dangerous times in the world in decades. He was talking about the geopolitical picture. He was talking about quantitative tightening. Do you agree here? Are we seeing this confluence of events, and are risks rising even at this level?
So he was referring in large part to geopolitical risk and the tragic events of the Middle East and the continued death of innocent civilians is of concern because it inflames feelings and it makes outcomes even less predictable. But if you step back away from this horrific period right now in the Middle East, but if you step back, we've had this notion of what the G20 has called cascading crisis, or my co-authors and I call permacrisis, the sense that we stumble from crisis to crisis. And we believe there are three reasons for this. One is the inability to generate durable, high, and inclusive growth that respects the planet. Two is repeated policy mistakes, and sometimes the same policy mistakes being made over and over again. And three is the lack of global policy coordination. So when you have these three things, you will end up with unusual uncertainty, you will end up with fluidity, you will run down your human resilience and your financial resilience. That's the bad news. The good news is that there are ways, concrete ways to address all three that can get us out of this permacrisis, that can put us on a road of virtuous cycles, not vicious ones. But it's not going to happen in the next 1 or 2 years. This is more a 2+ year outlook. But it is a hopeful book because we believe that you can address all three of these issues.
Now, I know your co-author, Gordon Brown, is more the sort of the politician of the group, so to speak. But I am curious, one of the things you talk about is global leadership as being one of the solutions here. And, I look at a moment, at least here in the U.S., where the House of Representatives can't even elect a speaker, right? So are we going to get that global leadership? You say it's an optimistic book. Are you optimistic on that point in particular?
And that has been sort of an issue of heated discussion among the authors. And to be clear, this was born of Zoom calls. During the lockdown, three of us, Gordon Brown, Mike Spence, Nobel Prize winning economics, and I would get together on a regular basis to talk about the world. And it was very frustrating because we were worried. We kept on hearing notions of, when we open up the economy after this lockdown, everything is going to be fine. And we say, that's not how economies work. It's not a light switch that you simply put it on and everything comes on. When you reopen an economy, things are in the wrong place. Then we kept on hearing about how bad the vaccine distribution was. And we kept on saying, be careful, because we could get a variant from South Africa. We could get a variant from India. And then we pivoted when we became more hopeful, when we sort of understood what was at the core of all this. The lack of political leadership is an issue, yes. But if you look, and the book covers the history of liberal democracies, is that you end up getting to the right leadership. It's hard. It doesn't happen as quickly as we'd all like to, because at the end of the day, the people, the citizens need it. They want it. And there is a lot of concern right now about inequality, about climate change, about what's happening around the world. So people are looking for leadership, and the hope is that we will get there. We will iterate to that.
That was my conversation this morning with Mohamed El-Erian. Coming up, it's time for closing time here on Yahoo Finance. We're going to recap the top stories of the day, get you set for everything you need to know tomorrow. Stay tuned. Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Let's take a look at some of the trending after-hours tickers right now. Intuitive Surgical, the maker of the Da Vinci surgical robot, out with its numbers after the close, and the company's losses are accelerating here. Stock is off by 8.5% right now, and that's after the company reported revenue in particular that was below analyst estimates. Revenue did rise by 12%, but it came in at $1.74 billion. That was a slight miss compared to what analysts were estimating. The installed base is now almost 8,300 systems here, but that too looks to be a little bit shy of estimates. Intuitive's had a pretty volatile year, if you will. The stock is up about 3% year to date, but you can see there has been quite a lot of whipsawing around. Let's also look at WD-40, of course, the maker of the namesake lubricant. Those shares down in 5.1% in after-hours trading. And that's after its forecast was below estimates. WD-40 forecasting of up to $5.15 in profit this year. $5.30 is what analysts had been anticipating. And the company talking about this being a time of investment. It's doing some restructuring as well. It talked about that in its statement. But really, it looks like investors are focusing in particular on that forecast, and that's why we're seeing the stock trade lower. And then if we look at CSX, of course, the railroad company, those shares not doing a heck of a lot in after-hours trading after its earnings reports. But the company came out with earnings per share a penny shy of analyst estimates, revenue falling 8.5% year over year, but beat estimates. And then if you look, the company is talking about its various lines of business here. Total carloads were down year over year, but if you look at the individual areas and where it saw growth, automotive, that was an area of strength. Fertilizers was an area of strength in terms of what it is moving around the continent here. So we'll keep an eye on CSX, not just for what it said, but kind of for what it indicates about the broader economy.
And it is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Oil prices topping $90 a barrel. That's amid rising tensions in the Middle East. The Defense Department confirming a U.S. Navy warship intercepted 3 missiles and several drones near Yemen. Pentagon spokesman saying the missiles were launched by Houthi forces in Yemen, but it's unclear what the target was. This coming after U.S. bases in Iraq and Syria came under drone attacks earlier this week. CVS reportedly taking some cold medicines off store shelves. The Wall Street Journal is saying the move comes after an FDA advisory panel said a key ingredient in a common decongestion is ineffective. CVS is doing this proactively. The FDA hasn't asked manufacturers or retailers to remove products from shelves.
And finally, Americans must earn more than ever to afford a home. A new report from Redfin says buyers need a salary of $114,000 to buy a typical home in September. That assumes a 7.2% mortgage rate on a home priced at just over $400,000. And it's time now for What to Watch on Friday. Investors can look forward to more Fed speak. Cleveland Fed President Loretta Mester expected to deliver remarks on the economy. This coming as Fed Chair Jay Powell warns that inflation is still too high, that more interest rate increases are still possible. Friday is going to be the last day before the beginning of the Fed's blackout period. We've been hearing from a lot of them ahead of that. On the earnings front, American Express, Comerica, Huntington Bank among the list of names reporting their latest results. The three companies reporting before the opening bell, providing more color on the state of consumer spending. And lastly, be sure to tune in tomorrow to Yahoo Finance for our conversation with Eurasia Group founder and President Ian Bremer on the latest in Israel, as well as the speaker saga on Capitol Hill. We'll also be talking with HPE CEO Antonio Neri on the future of the company following its securities analyst meeting. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow for all of that and lots of market coverage. 3 p.m. Eastern. We'll be here, so should you.